Have you ever wondered what it truly means to be an investor? What are the perks, the pitfalls, and the ultimate secret to using investing as a pathway to becoming a billionaire? Let's dive deep into the world of investing, break it down, and unlock its potential. First things first, what exactly is an investor? An investor is someone who allocates capital, money, time, or resources into an opportunity with the expectation of future financial returns. Investors exist in various forms, including individual retail investors, institutional investors like pension funds, and venture capitalists funding startups. Investors operate in multiple asset classes such as stocks, bonds, real estate, cryptocurrencies, or businesses. They assess risk, forecast returns, and strategically place their resources to achieve financial growth. The concept revolves around risk versus reward. The higher the risk, the higher the potential return. Understanding the mindset of an investor is crucial. They don't merely spend, they invest with a purpose, looking for growth and value. Becoming an investor isn't limited to those with vast amounts of capital. Anyone with a disciplined savings plan and strategic thinking can enter this domain. Let's explore the key benefits of being an investor. Investing offers numerous advantages, starting with wealth creation. Investments grow over time, allowing you to compound your wealth and achieve financial independence. For instance, investing in stocks with consistent dividends or in real estate with rental income can create passive income streams. Another advantage is diversification. By investing in multiple asset classes or sectors, you can minimize risks. For example, if the stock market takes a dip, real estate investments or bonds may still provide stability. Additionally, investing helps you stay ahead of inflation. Assets like gold, real estate, or index funds tend to grow at a rate that outpaces inflation, preserving your purchasing power. Long-term investments also come with a tax benefits in many jurisdictions, making it a financially sound strategy. But with every great opportunity comes challenges. What are the disadvantages? Investing is not without risks. Market volatility can lead to significant losses, especially for those who make emotional or uninformed decisions. For instance, the 2008 financial crisis wiped out trillions of dollars in wealth due to market crashes. Investors also face liquidity risks. Tying money up in illiquid assets like real estate or long-term funds can restrict access during emergencies. Additionally, the time and effort required to research, monitor, and adjust investments can be daunting for beginners. Another disadvantage is the impact of external factors. Economic downturns, inflation, and geopolitical tensions can negatively affect even the most well-planned investments. Finally, beginner investors often fall prey to scams or make poor decisions due to a lack of knowledge. Did you know that time is your greatest ally when it comes to investing? Let's talk about compound interest, the eighth wonder of the world. Compound interest is the process where your investment earns returns, and those returns are reinvested to generate even more returns. Over time, this creates exponential growth. For example, investing $10,000 at a 7% annual return will grow to over $76,000 in 30 years without adding more money. The earlier you start, the more powerful compounding becomes. A 25-year-old investing $200 monthly at 8% annual growth will have over $600,000 by retirement. In contrast, someone starting at 35 will accumulate less than half of that with the same contributions. This principle underscores the importance of patience and consistency. The longer you stay invested, the greater the snowball effect of your earnings. Whether through stocks, mutual funds, or even high-yield savings accounts, leveraging compound interest is a cornerstone of successful investing. Spreading your investments is key to reducing risk. Let's break down diversification. Diversification involves allocating your investments across various assets to reduce exposure to risk. Think of it as an insurance policy for your portfolio. If one investment underperforms, others may compensate, stabilizing your overall returns. For example, a diversified portfolio might include stocks, bonds, real estate, and gold. During a stock market downturn, bonds or real estate could maintain or increase in value, minimizing losses. Diversification doesn't eliminate risk, but it significantly mitigates it. Global diversification is also essential. Investing in international markets exposes you to opportunities in emerging economies and protects you from localized economic downturns. Tools like mutual funds, ETFs, and robo-advisors simplify diversification for beginners. Getting started can feel overwhelming, but it's easier than you think. Here's how to take your first steps into investing. Start by identifying your financial goals. Are you saving for retirement, buying a home, or growing wealth? Knowing your objectives will guide your investment choices. Next, assess your risk tolerance. Are you comfortable with volatile markets, or do you prefer stable, lower-risk investments? Open an investment account like a brokerage or retirement account. Robo-advisors are excellent for beginners, offering automated portfolio management based on your preferences. Start small. Investing $50 to $100 monthly can grow significantly over time. Focus on index funds or ETFs, which offer low-cost, diversified exposure to market. As you learn, consider diversifying further with individual stocks or real estate investments. Should you focus on quick gains or play the long game? Let's explore the difference between long-term and short-term investments. Long-term investments such as stocks, real estate, or retirement accounts focus on sustained growth over years or decades. These investments benefit from compound interest and the ability to weather market volatility. For instance, the stock market has historically provided an average annual return of 7% over the long term. In contrast, short-term investments like savings accounts, certificates of deposit, or money market funds prioritize liquidity and lower risk. These are ideal for saving for near-term goals, such as a vacation or emergency fund. However, short-term gains often come with lower returns. The right strategy depends on your financial goals. A balanced approach might include a mix of both. For example, allocate a portion of your funds to a high-interest savings account for immediate needs while investing the rest in stocks or ETFs for the long haul. Well viewers, if you didn't subscribe to our channel yet, please subscribe now. Technology has revolutionized investing. How can you leverage it to your advantage? Technology has made investing more accessible and efficient. Robo-advisors like Betterment or Wealthfront use algorithms to manage portfolios based on your financial goals. These tools simplify investment decisions and reduce fees compared to traditional financial advisors. Mobile apps such as Robinhood or eToro allow anyone to trade stocks, cryptocurrencies, or ETFs with minimal barriers. Advanced analytics and AI tools provide real-time insights, enabling better decision-making. Additionally, blockchain technology has introduced new asset classes like cryptocurrencies, which are decentralized and borderless. However, with these advancements come risks. Over-reliance on technology may lead to impulsive decisions, and the unregulated nature of some platforms can expose investors to fraud. Use technology as a tool, not a substitute for education and strategy. Success in investing isn't just about making profits. It's also about managing risks effectively. Risk management is the process of identifying, assessing, and mitigating investment risks. It involves strategies such as diversification, setting stop-loss orders, and regularly rebalancing your portfolio. Understanding your risk tolerance is critical. For instance, younger investors with a longer-term horizon can afford to take more risks compared to retirees relying on fixed income. Investing in safe haven assets like gold or government bonds can act as a hedge during economic downturns. Another important principle is not to invest money you can't afford to lose. Always maintain an emergency fund separate from your investment capital. Educating yourself about market trends, economic indicators, and investment vehicles reduce the risk of uninformed decisions. Why do emotions often lead to poor investment decisions? Let's discuss the psychology behind successful investing. Behavioral biases like fear, greed, and herd mentality can derail even the best investment strategies. For example, during market downturns, many investors panic sell, locking in losses instead of waiting for recovery. On the flip side, overconfidence during bull markets can lead to reckless decisions. Successful investors manage emotions through discipline and long-term focus. Strategies like dollar cost averaging, investing a fixed amount regularly, reduce the impact of market volatility. Setting clear goals and sticking to them helps maintain perspective during market fluctuations. Education also plays a key role. Understanding market dynamics builds confidence and prevents impulsive decisions. Journaling investment decisions can help identify and correct biases over time. Taxes can eat into your investment returns, but understanding the rules can save you money. Tax-efficient investing involves minimizing the amount you owe on capital gains, dividends, and interest income. For instance, long-term investments, those held for over a year, often benefit from lower capital gains tax rates compared to short-term investments. Utilizing tax-advantaged accounts can shield your investments from immediate taxation. These accounts allow your money to grow tax-free or tax-deferred, depending on the account type. Additionally, some strategies, such as tax loss harvesting, let you offset taxable gains by selling underperforming assets. Understanding local tax laws is essential, as tax rates and rules differ by jurisdiction. Working with a tax advisor can help you optimize your investment strategy for your specific situation. Avoid common pitfalls like overtrading, which can increase your tax liability. Passive income is the holy grail of financial freedom. But how does it tie into investing? Passive income refers to earnings generated with minimal active effort, such as dividends, rental income, or interest from bonds. Investments that generate passive income can provide financial security and help you achieve your goals faster. Dividend-paying stocks are a popular choice for passive income. These companies distribute a portion of their profits to shareholders, providing regular income while retaining growth potential. Similarly, real estate investments can generate rental income, and REITs, real estate investment trusts, offer a hands-off alternative for property investing. Other options include peer-to-peer lending, where you earn interest by funding loans and creating digital products like e-books or courses that sell automatically over time. Building multiple streams of passive income diversifies your earnings, reducing reliance on any single source. This approach can fund early retirement, travel, or simply greater financial freedom. Is it possible to become a billionaire through investing? Let's unpack the blueprint to extraordinary wealth. Many billionaires, including Warren Buffett and Ray Dalio, build their fortunes through disciplined investing. The key lies in compounding, strategic diversification, and seizing high growth opportunities. Early and consistent investing in equities or innovative industries can yield exponential returns. For instance, those who invested in tech stocks like Apple or Amazon during their early stages saw unparalleled growth. Real estate is another avenue, offering both passive income and capital appreciation. However, becoming a billionaire also requires calculated risk-taking and identifying disruptive trends such as renewable energy, artificial intelligence, or blockchain. Long-term vision is crucial. Successful investors often hold onto their investments despite temporary market turbulence. Leverage and reinvestment are also critical. Reinvesting profits into high growth opportunities amplifies returns. For example, Buffett reinvested earnings from Berkshire Hathaway's various ventures to create a financial empire. Now you have a roadmap to mastering the art of investing, from leveraging compounding interest to building passive income streams. Each of these strategies can transform your financial future. Which strategy resonates with you the most? Share your thoughts in the comments below. We'd love to hear your journey. Don't forget to like, subscribe, and hit the bell icon to stay updated on more content that helps you achieve financial freedom. See you in the next video.